The stock market, the thing everyone obsesses over, is actually the little market. I know. That sounds insane. Your 401k, the Dow Jones, Elon Musk tweeting a meme that moves a stock 30%, that's the stuff that dominates every financial headline you've ever read. But here's what nobody tells you. The global bond market is worth over $130 trillion. The entire global stock market, roughly $90 trillion. Bonds are bigger. Bonds are older. And bonds, more than almost any other financial instrument on Earth, quietly determine the cost of your mortgage, the stability of your job, whether the government can afford your roads, and yes, whether that stock portfolio you're so proud of goes up or down. And yet, if I walked up to 100 random adults and asked them to explain what a bond actually is. Research from the FINRA Investor Education Foundation found that fewer than 34% of Americans could correctly answer basic bond literacy questions. 34%. For a market that is literally the backbone of the global financial system. Stay with me, because what I'm about to show you isn't just investing 101. Understanding bonds is understanding power, who has it, who lends it, and how the entire global economy gets priced. So why does almost nobody understand bonds? Here's where it gets interesting and genuinely a little psychological. It comes down to something researchers call salience bias, a well-documented cognitive bias where our brains assign more importance to things that are vivid, visual, and emotionally stimulating. Stocks are exciting. They go up, they crash, they make headlines, they make millionaires on Reddit. Bonds. Bonds are a contract, a piece of paper, a promise. There's no ticker tape drama. There's no Elon tweet. So our brains, which are wired for narrative and novelty, just skip them. But here's what's really happening when you ignore bonds. You're walking around with a massive blind spot in your financial understanding. A 2019 study from the University of Chicago's Booth School of Business found that retail investors who lacked bond market literacy were significantly more likely to panic sell equities during rate-rising environments, because they didn't understand why stocks were falling. They didn't know that rising bond yields make stocks relatively less attractive. They just saw red and ran. That's the real cost of not understanding bonds. It's not just missing out on an asset class. It's making worse decisions everywhere else. Now, most people hear bonds and think, boring, low return, something my grandparents held in their retirement account. And look, I get it. That framing is everywhere. But that mental model is about 40 years out of date, and it might be costing you more than you think. Let's fix that. From the ground up, here's the simplest, most honest way to think about a bond. A bond is a loan. You are the bank. When a government or corporation needs money, and they always need money, they have two choices. They can go to an actual bank, or they can go to you, to the public, to investors. They issue a bond, which is essentially a formal IOU that says, lend us $1,000 today, we'll pay you interest every 6 months, and in 10 years we'll give you your $1,000 back. That's it. That's a bond. The institution issuing the bond is called the issuer. The interest they pay you is called the coupon, a term that literally dates back to the days when bondholders would clip physical coupons from paper certificates to collect their interest payments. The date they pay you back your original sum is called the maturity date. And the original amount you lent, that $1,000, is called the face value or par value. Now here's where it gets genuinely important. And this is the piece that trips up almost everyone, even financially literate people. Bonds don't just sit still. They trade. After a government issues a bond, that bond can be bought and sold in what's called the secondary market, just like stocks. And this is where bond prices become a live, breathing reflection of what investors collectively believe about the future of the economy. Ready for the most counterintuitive rule in personal finance? When bond prices go up, bond yields go down. When bond prices go down, bond yields go up. They move in opposite directions. Always, without exception. Let's go back to that $1,000 bond. Say it pays you $50 a year in interest. That's a yield of 5%, $50 on a $1,000 investment. Now imagine interest rates in the broader economy rise to 7%. Suddenly, new bonds being issued are paying $70 a year. Your old bond, still paying $50. It's less attractive. Nobody wants to pay $1,000 for a bond yielding 5% when they can get 7% elsewhere. So the price of your bond drops maybe to $700 until the $50 annual payment represents a yield competitive with the new market rate. Price down, yield up. The reverse is also true. If rates fall, your existing bond locked in at 5% becomes more valuable than newly issued bonds paying 3%. Demand rises, price rises, yield falls relatively. This is not abstract. This is the mechanism that directly impacted $8 trillion worth of bond portfolios in 2022, when the Federal Reserve raised interest rates at the fastest pace since the 1980s. Investors who didn't understand this relationship watched the safe part of their portfolio drop 15–20% and had no idea why. But here's where it gets better. Because once you understand this relationship, an entirely new layer of the financial world opens up. Here's a question most people never think to ask. Why does the U.S. government, the most powerful economic entity in human history, need to borrow money from you? The answer reveals something fundamental about how modern economies actually work. And it's a little uncomfortable. Governments almost never collect enough in taxes to cover everything they spend. That gap, the difference between what comes in and what goes out, is called the budget deficit. And the way governments finance that deficit isn't by printing cash. Well, not only that. It's by issuing bonds. U.S. Treasury bonds, specifically called T-bills, T-notes, or T-bonds depending on their maturity length. As of 2024, the U.S. national debt stood at over $34 trillion. Every single dollar of that debt exists as a bond, a promise made to someone somewhere that the U.S. government will pay them back with interest. The largest holders, foreign governments, pension funds, insurance companies, and increasingly ordinary investors like you. Now here's what nobody tells you about government bonds specifically. They are, by design, considered the closest thing to a risk-free investment that exists in global finance. Not because governments are perfect, history is littered with sovereign defaults, but because a government that controls its own currency can, in the absolute worst case, create money to repay its debts. That's the implicit guarantee. And that guarantee is why U.S. Treasury yields serve as what economists call the risk-free rate, the baseline against which every other investment on Earth gets measured. A landmark 2003 study by economists at Princeton University, examining post-war sovereign debt markets, found that the perceived safety of government bonds creates a gravitational pull on global capital. When fear rises, money floods into bonds, driving prices up and yields down. When confidence rises, money flows out of bonds and into riskier assets like stocks, driving yields up. This is why bond yields are often called the mood ring of the global economy. They don't just reflect what's happening. They predict what investors collectively believe is coming. And this brings us to something that directly affects your life, whether you own a single bond or not. Here's where it gets genuinely powerful. Not all bonds are created equal. A U.S. Treasury bond and a bond issued by a struggling startup are both bonds, but they carry wildly different levels of risk. And the market prices that difference through something called the credit spread or yield gap. Here's how it works. If a 10-year U.S. Treasury bond is yielding 4.5% and a corporate bond from a mid-size company is yielding 7.5%, the spread between them is 3%. That 3% is the market's price for the additional risk of lending to that company instead of the U.S. government. The wider the spread, the more nervous investors are. The tighter the spread, the more confident. Research from Harvard Business School's finance department has consistently shown that credit spreads are among the most reliable leading indicators of economic recessions. When spreads blow out, when corporate bonds start yielding dramatically more than government bonds, it means the smart money is pricing in a wave of corporate defaults. It's a stress signal. Every major recession in modern history, including the 2008 financial crisis and the initial shock of the 2020 pandemic, was preceded or accompanied by dramatic credit spread widening. Now, I know what you're thinking. Okay, This is fascinating, but I'm not a bond trader. Why does any of this matter for my actual financial life? Here's why. Because the psychology of the bond market, the collective fear and confidence expressed through trillions of dollars of daily trades, flows downstream into everything. When bond yields rise, mortgage rates rise. When corporate spreads widen, companies pay more to borrow, which means fewer hires, tighter budgets, slower growth. When government bond yields spike, the cost of servicing national debt grows, which means less money for public services. The bond market isn't separate from your life. It is the infrastructure of your financial life. You just haven't been able to see it until now. Now, I know this sounds like a lot to absorb, and I want to address something directly because I see this thought pattern constantly. I'll leave bonds to the professionals. I'm just going to stick with index funds. Look, I respect that. Index funds are genuinely great. But here's the thing nobody tells you about that strategy. Your index fund already has an opinion about bonds. A target date retirement fund. It's automatically shifting your allocation toward bonds as you age. Even a pure equity index fund's valuation, the price-to-earnings ratio that determines whether stocks are cheap or expensive, is calculated relative to bond yields. Ignoring bonds doesn't protect you from them. It just means you're being affected by forces you can't name, can't anticipate, and can't respond to intelligently. Research from MIT Sloan School of Management found that investors with even a basic understanding of bond market mechanics demonstrated measurably better portfolio decision-making during volatile rate environments. Not because they became bond traders, but because they understood why their existing investments were behaving the way they were. Knowledge doesn't complicate your strategy. It stabilizes your behavior. And in investing, behavior is everything. Let me be direct with you for a second. If you've spent years feeling vaguely intimidated by financial news, confused when reporters talk about yield curve inversions, or the Fed hiking rates, or flight to safety, you're not behind. You weren't taught this. The financial system was not designed to be transparent. The language is dense, the concepts are deliberately kept behind jargon, and the implicit message from most financial media has always been, leave this to the experts. But here's what's really happening when you finally understand the bond market. You stop reacting emotionally to financial noise and start reading it as information. The 2008 financial crisis wiped out an estimated $19.2 trillion in household wealth in the United States, according to the Federal Reserve's own post-crisis analysis. And study after study in behavioral economics, including foundational research from Daniel Kahneman and Amos Tversky at Princeton, the work that eventually won Kahneman a Nobel Prize, shows that the losses ordinary people suffered weren't just due to the crisis itself. They were amplified by loss aversion and decision fatigue, people making panicked, uninformed decisions in real time because they didn't understand the system they were inside. Understanding doesn't make you immune to market volatility, but it makes you less afraid of it. And that reduction in fear-driven decision-making is worth more to your long-term financial health than almost any specific investment strategy. Your brain isn't broken for finding this confusing. The system is genuinely complex, but complexity isn't the same as inaccessibility, and you just proved that by getting this far. So let's bring it all together with one powerful idea. The bond market is the world's largest, oldest, most important financial market, and understanding it gives you a second set of eyes on the entire global economy. When you see bond yields rising, you now know. Borrowing is getting more expensive, stocks may face headwinds, and the Fed is likely tightening. When you see credit spreads widening, you know. The market is pricing in fear. When you hear about a government rolling over its debt, you know. They're issuing new bonds to pay off old ones, and the rate they pay reflects exactly how much trust the world has in them at that moment. That's not just knowledge, that's fluency. And financial fluency is one of the highest return investments you will ever make in yourself. Here's your one specific next step. Look up the current 10-year U.S. Treasury yield today. Just Google it, then check it again in a month. Watch how it moves in relation to news about inflation, Fed meetings, and stock market swings. You don't need to buy a single bond to benefit from watching that number. It will start rewiring how you read the financial world almost automatically. The bond market has been running quietly in the background of your financial life this whole time. You just learned to hear it. If this shifted something for you, drop a comment below. Tell me what concept finally clicked. Because I read every single one, and honestly, your questions shape what this channel covers next. And if you want to go deeper on how the Federal Reserve actually uses the bond market to control the economy, that video is coming. Make sure you're subscribed so you don't miss it. You're not a passive observer of the financial system anymore. You're starting to understand how it actually works. That's the most important thing you can do with the next chapter of your financial life.